Silver just did exactly what the chart predicted. We mapped the bounce, we hit the targets. But the new policy move out of Washington, the Comex data, and the war risk that just spiked, those were not on the chart, and they can change everything about what happens next. Last video, I walked you through the silver daily chart, marked the February 6th candle as key support, explained the swing failure pattern, laid out 72.6 to 70 as the support zone, said, if price holds that area and we get displacement, upside targets are 75, then 77. Silver is now trading around 75.5. Price bounced from that support exactly as mapped. So yes, the chart worked. But if all you're watching is candles, you're missing the part of the story that actually moves markets for months, not hours. Later in this video, I'll show you the one number from Comex that tells you if this move is just a trade or the start of a repricing event. And before we're done, I'll give you a simple checklist for what to watch around the FOMC minutes and into March delivery. Quick reset, where we actually are. RateScope here. Let's anchor where the market sits right now. Silver Western Spot, 75. Silver Western Futures, 75. Shanghai Spot, 86. Shanghai Futures, 88. That's about an $11 East-West premium. Silver is more expensive where the physical pulls hardest. Gold Western Spot is sitting near 4,930. Today at 2 p.m. Eastern, we get the FOMC minutes. That is a high-impact window for volatility. Not because the words themselves are magic, but because algos and macro funds use that timestamp as a trigger to rebalance, spoof, and flush weak positions. The economic calendar doesn't just say, news here. It says, this is the hour the big hands are allowed to hit the tape. Keep that in mind when you see a 50-cent candle appear out of nowhere. The only silver levels that matter right now. Let's tighten the technicals. On lower time frames, structure is still constructive for now. Upside objectives. First target, 77. Next target, 78.2. Those are the most realistic zones price can explore if buyers stay in control and the FOMC minutes don't nuke the structure. Immediate downside support. Zone, 74.8 to 73.9. For me, what matters is wicks into that zone equals fine. That's just liquidity tests. Bodies closing below 73.9 equals that's weakness. That tells you the bounce is no longer clean and the market is starting to chew through bids. The February 6th candle is still the anchor. We do not want daily bodies closing down into the wick of that move. Tagging the wick intraday, acceptable. Closing candles inside it signals the market is willing to erase the whole reaction. If we start seeing daily bodies closing below the 72.6 to 70 support zone, then the roadmap shifts. Lower targets open up, 67 and potentially even below that Feb 6th wick. The current move becomes a failed bounce, not the base of a new leg. With the FOMC minutes at 2 p.m., you need to be ready for both directions. Scenario A. News used as fuel to run stops and push towards 77 to 78. Scenario B. News used as an excuse to pull the rug and punch through support. This is not a predict the line moment. This is a watch how price reacts at the line moment. If you need a refresher on the exact levels, go back to the last video. I won't redraw all of them here. Now let's talk about the thing the chart couldn't show you. A new price floor architecture for critical minerals that changes the backdrop of this entire move. The mid-reveal, a price floor for strategic metals. Here's what hit the tape overnight. The US has developed a critical minerals price floor system. They're actively pitching it to allies. Goal: reduce dependence on China for resources labeled critical to national security. Key details: multiple agencies are involved. A sophisticated price floor mechanism has already been modeled. Officials confirm talks with allies and partners are ongoing now. Internal line: pricing is the key to unlocking private investment. On the back of this, gold popped around $90 to $4,956. Silver jumped over $3 to around $75. Why does a price floor matter? Because a government-backed minimum price for strategic commodities, silver included, means a guaranteed basement, regardless of what a paper market tries to do in a panic. A policy anchor under the entire cost curve. For years, the main weapon of the paper market has been smash price below production cost, force weak miners and weak hands to sell, create the illusion of plenty and no problem. When a price floor is enforced, that tool gets blunted. This isn't fully implemented policy yet. It's in the pitched to allies phase. But the direction is clear. Silver moves from traded commodity toward strategic commodity. And once you're labeled strategic, policy starts to matter more than trader games. Ray Dalio has been laying this out for a decade. Long debt cycles peak, deficits grow, trust in government paper erodes, capital rotates from financial assets into hard assets. His recent framing, hard assets are essential, not optional. That tells you institutions are quietly moving the same way, even if price hasn't fully caught up. Keep that in the back of your mind when you see someone cheering a short-term dip. Comex supply stress, the math you can't ignore. Now, the part nobody can hand-wave away, Comex. Current snapshot, registered silver, 92.2 million ounces. March open interest, 285.3 million ounces. That's roughly 193 million ounces more paper claims than deliverable metal. One day last week, nearly 5 million ounces left Comex vaults. About 800,000 ounces moved from registered to eligible. Total registered is down to about 92 million. That's the pool available to actually settle futures contracts, not theoretical ounces, not in-the-ground someday ounces. Now, ounces. The withdrawals are accelerating, not slowing. Roll mechanics. March open interest shrank from about 293.9 million to 285.3 million. That's only 7.66 million ounces of roll progress. To comfortably cover March delivery at this stage, rolls would need to be roughly 30 million ounces per day. We are nowhere near that. Now layer on the curve, March to May spread, million minus 52. After financing, storage, insurance, carry-adjusted contango, 4.9. In English, the market is paying you almost nothing to move your risk from March to May. There's no decent incentive to roll, so contracts stay in March. Upward pressure on delivery builds daily. When you combine a shrinking registered pool, sluggish roll, weak contango, you get one simple conclusion. The price of silver is too low for the structure of this market. It doesn't mean moon tomorrow, but it does mean we are walking toward a point where paper pricing and physical reality cannot coexist quietly. In a minute, I'll show you how mining results plug into this, because that's where you see what happens when price even slightly adjusts toward real conditions. Mining profits, reality when price lifts its foot off their throat. Look at Hecla Mining's latest numbers. Revenue, $1.4 billion plus, up 53% versus 2024. Net income, $321.2 million, roughly 9x growth year over year. Silver production, 17 million ounces at the high end of guidance. Strong cash flows. Total debt, cut by 50% down to about $276 million. Net debt, only about $34 million. All operations, free cash flow positive. This is what you see when prices move even partially toward true supply-demand, instead of staying stuck under a paper thumb. For years, miners have been run at or below marginal cost in silver. That is not a free market. That is financial repression of a sector. The moment price gets breathing room, balance sheets heal fast. Now tie that to Jim Rickards' argument in Currency Wars. In geopolitical realignment, commodities get weaponized. Nations secure energy, metals, and ag, not just for profit, but for survival and leverage. The U.S. experimenting with a price floor for critical minerals is exactly that. Not a random stimulus, a strategic decision. We'd rather guarantee supply at a higher cost than be dependent at a low cost. Once you frame silver as strategic industrial input, monetary hedge, and a pillar of national security policy, you should expect pricing and access to look very different going forward. The war fuse, Iran and the Strait of Hormuz. Now add geopolitics. Reports coming out say the U.S. is moving closer to a potential large-scale conflict with Iran. Not a pinprick strike. We are talking about scenarios described as weeks-long war if launched. Key points. Peace talks are ongoing, but major gaps remain. Washington has been rapidly building military presence. Carriers, warships, fighter jets, additional weapons and systems. Some insiders are now floating timelines of weeks if diplomacy fails. Why does this matter for silver traders? Because about 20% of global oil passes through the Strait of Hormuz. A weeks-long conflict there, doesn't just spike oil. It disrupts global manufacturing supply chains that depend on Middle Eastern energy, which hits industrial silver demand paths at exactly the time we're in the 6th year of a structural deficit. So you have a structural supply deficit, Comex inventory stress, a proposed price floor for critical minerals, and a war risk in the key artery of global energy. That setup is not just another Tuesday in markets. Mining stocks, from 1% afterthought to strategic slot. Now zoom out to mining versus global equities. History. From 1900 to 1965, mining averaged about 8% of global equities. From 1955 to 1965, it peaked near 10%. Today, mining sits at approximately 1% of global equities. That's a 6-decade low, historic underweight. To just return to the long-term average, mining would need to rise roughly 8 times relative to global equities to reach peaks last seen in that mid-20th century period, closer to 10x. At the same time, governments are reshoring industry, re-engineering supply chains, prioritizing energy and material security over just-in-time efficiency. None of that happens without metals, fuel, mining, and energy capacity. So mining shifts from a cyclical bet to a long-term strategic slot in portfolios and policy. Charles Mackay's Extraordinary Popular Delusions and the Madness of Crowds is basically a manual on where we are. Crowds swing from maximum pessimism to maximum euphoria. Prices overshoot both ways. Mining at 1% of global equities surface, while states are designing price floors for minerals, is exactly that maximum pessimism. Most investors only adjust after that ratio has already moved. Gold miners versus S&P, the quiet base. Gold miners versus the S&P 500 are pressing against the top of a decade-long range. In 2011, that ratio was about 3x higher than it is today. But this gold cycle is different. Central banks are net buyers of gold. Global trust in U.S. policy and in the dollar is structurally weaker. Inflation is sticky. Fiscal deficits are not being fixed, only rolled. Analysts are comparing the current setup to the 1970s. Stagflation, currency debasement, hard assets and miners massively outperforming the broad indices. Could they be wrong? Yes. But ignoring that pattern just because tech momentum feels good today is not a risk-managed decision. The bear case still matters. Let's be fair, the bullish stack of evidence doesn't mean straight line up. Bear case points. FOMC minutes at 2 p.m. could spark volatility that breaks the 74.8, 73.9 zone, or even drags us back towards 72.6, 70. Iran war rhetoric may cool if diplomacy actually gains traction, removing some geopolitical premium. The critical minerals price floor system is still in discussion phase, not a locked-in global policy. March open interest might still accelerate its role in the final days, as we've seen in prior cycles. Comex registered at approximately 92 ounces is still technically enough if the classic 5% delivery pattern holds. Mining at 1% of global equities could remain depressed if institutional capital refuses to leave tech/AI. This is probability work, not prophecy. Why this ends in violent repricing, not a gentle drift. Here's the through line that ties everything together. Technical levels are behaving the way we mapped them, giving short-term traders a clear framework. Comex's supply-demand situation is tightening, not easing. The U.S. is building a strategic price floor concept for key minerals, signaling a shift from pure free market to managed scarcity. War risk is rising in a corridor that controls 20% of global oil. Mining is at a historical underweight, just as governments are reprioritizing real resources. FOMC minutes today are the catalyst that can decide whether the next leg is a clean continuation higher or a messy retest lower. The informed minority understands. Price is a signal, but it is not always an honest signal. When a market has been held below its true cost structure for years by paper games, the correction is not smooth. It is not plus 10 cents each week for 5 years. It is a period where nothing happens, followed by a period where everything happens at once. Physical reality eventually overwhelms paper fiction. That is when you see the violent repricing. The people who are ready for that are not the ones trading headlines. They are the ones who know their key levels, understand the structural backdrop, size their risk so they can survive shakeouts. What to watch next? Checklist. Here's your near-term checklist. FOMC minutes, 2 p.m. Eastern. Does silver hold above 74.8 to 73.9 on a closing basis? Do we get a stop-run wick lower followed by strong recovery, or a clean breakdown? East-west spread. Does the $11 Shanghai premium stay wide, widen, or compress sharply? Persistent wide spread equals physical bid remains stronger east than west. Comex Daily Data Watch registered inventory and March open interest day by day. Look for large withdrawals, stalled roll, any sudden magical inventory appearance. Critical minerals floor news. Track whether this stays in talks or moves into formal proposals or MOUs with allies. The moment this becomes actual policy language, discount windows for cheap silver start closing. Geopolitics. Strait of Hormuz headlines. Any movement of carriers, jets, and bases from pre-positioning into actual engagement. Put all of that on top of your chart. Let price action confirm or reject the story.